afternoon, everybody. Welcome to our next in the business benchmarking series. Actually, it's the last one we have for the year. This is our actually 12th session that we've had, a mixture between the ones we started off with, our PPP ones early in the year, to the ERC ones, and then getting into general content around some of the basics, the 101s plus for financial considerations. Today, we'll be having another session with our partner in crime, John Rizzo, who is the managing partner at RDG+Partners, but they are the Inspire Care 360 financial experts. So thank you very much for joining today, and we'll go ahead and get started right now. So today, what we're going to do is do a few little housekeeping things as we normally do. And then we'll get in and give you a little bit of background on what we're going to be talking about. We're going to be handing it over to John and then talking about succession planning. As always, we have not only John here, but Rob is also in tow with Hans on the background. So if you do have specific questions for John or myself or the financial experts, please put them into the Q&A section. In the Q&A section, please detail your question and we'll go ahead and try to answer it live, or Rob will get to it in the back channel right back to you if it's something you want to learn more about. If you are seeking to learn more about the financial experts, IC 360, or something else that you have a question with that might be off topic, please use the chat function. And the chat function will come to Hans and or Rob, and they will field your questions for you. And then we'll be doing several polls today. So if you do have, we'd love to have your participation on these polls. These polls are always valuable for us to get a sense of where you're at and also keep these things interactive, in all candor. So with that said, let's go ahead and get started. First off, a few of the housekeeping items, and some of you have seen this before. A lot of you may have had, but Healthy Advantage is always a solution. It has been growing and growing in popularity with our members as well as some of those who are not. But again, it is highly affordable for our teachers, which is critically important. Unlike major medical, unlike voluntary plans only, the Healthy Advantage program was built for affordability so they can start using the services at $1 and not have to complete a deductible. It is super flexible. So in other words, the costs that go to the employer stays the exact same, but the flexibility for the employee allows them to choose different types of programs, from just a basic telemedicine all the way to the ultimate program, which is really not that expensive, and get many different benefits and features. It is very easy to implement because we do it in partnership with you. And what we mean by that is we also bring to the table benefit consultants who actually do the work to understand exactly what each one of your teachers or administrators, or yourself for that matter, are interested in, what you currently have as healthcare if you don't, and then how the plans best match up to you, and then work with you to ensure you get the right plan and get it set up correctly. So that benefit administrative team is typically something that doesn't come for small and mid-sized businesses, but only for large corporations. It is compliant for the ACA requirements, which is if you have 50 or more full-time equivalents, it does meet Part A of the Affordable Care Act, which is definitely the expensive one. And it is something that really scratches that itch for all of us, especially when you're trying to present something not only that checks the box for the Affordable Care Act, but really is something that can benefit our staff. So we've been growing greatly with the amount of members who have joined Healthy Advantage. And let's move forward. Then there's Inspire University. Many of you have come to us because of Inspire University, but just as a reminder, we're coming into the end of the year. For those of you members who have joined our call today, it is time to start thinking about updating your handbook. The annual updates is the time when you come in here and look at what are some of the things that you would possibly like to change in your handbook. We also will be making any federal and state changes for your handbooks. So please reach out to Jen or the team, and they will be sure to get some of those things done for you. But that all gets delivered through Inspire University. You obviously can have, for those of you who are not aware, your e-orientations, all the operation procedures and professional development, access to be able to have CDA courses at $199 per 120-hour course, which is sort of unheard of through the country. But because you're an IC360 member, we were able to bring that to our membership through our e-enrollments, which will be coming soon, and our plethora of e-professional development that is very unique to the industry. This is not about how staff and team members and administration work with the children. This is how they work with each other, how they're professionals in business. We see this as really unique in the industry, and there's not many other providers who've provided such high quality, very applicable knowledge that is easy to learn and then to apply on the job. And actually part of the learning is applying it on the job. And then our total rewards program, which you're going to hear much more about come in January. It is in a beta test with a number of our members. And that is in the process of not only being rolled out, but being benchmarked right now today. And then obviously you have an opportunity to distribute your own content, build your own e-learning, as well as distribute your own content through Inspire University. And you have an e-content builder, which allows you to build e-learning or using video, using different audio, PowerPoints, PDF files, what have you. All this comes with membership with Inspire University and much more. So if you want to learn more, if you're not currently a member of IC360 and you want to learn more, please put a little chat out there and we'll get back to you for sure and try to give you as much information to be helpful to you as possible. With that said, also too, forgot the last one is we have a survey engine. So you have a comprehensive survey engine attached to Inspire University. How do I forget? But that is one of the other values that we have within it. And this can be set up for both premier memberships, which most of them are, or enterprise, which are for very large multi-locations, well over 20 locations. And with that said too, now let's move forward. Coming tomorrow, for our members, we have some big news. We have an event that is coming, but we are not going to spoil the surprise today, but maybe by the image in the photo, it'll give you an idea of what might be coming in the near future in the cold, blustery winter. Either way, we have an event that is very special. And the reason we developed this event is because of our members. Our members asked for this. And so look for it tomorrow. You will start seeing information coming your way through both social media as well as through your emails. And we greatly look forward to engaging with you on this for all of our members. And now with that said, I'm going to ask John to pop on the screen. And with that, John, when he comes on, how you doing, John? How was Thanksgiving?
I'm doing great. Thanksgiving was good. I shouldn't have stepped on the scale though, yesterday morning. So now I feel like I can't eat for a while, but other than that, it was fantastic. I hope yours was the same.
Yeah, I felt like you were stepping on my scale altogether. It felt like it was two people. So
yeah,
it was a great time. Always to get to see some family and to avoid any topics at the table that were too crazy. So we had a good time, and I appreciate it. It's always good to get to see some other people too that I usually don't get to see. But with that said, why don't we start jumping into financial considerations? John, again, for all of you out there, he is leader of our financial experts for IC360. John is the managing partner over at RDG+Partners and has been working with a number of our members and, in successful engagements as well as different engagements to help them start to understand different elements of their business. So John, let me hand it over to you and then I'll give you control.
Awesome. Yeah. Once I have control, I can share my screen and we'll get into some succession planning here. All right, hopefully everyone can see that. So like Tony mentioned, thanks again for having us. We're excited to spend an hour or so here with everybody, focusing on succession planning, building your business up for success. As Tony mentioned, I'm your presenter today, John Rizzo. Hopefully I've met all of you virtually by now, and we're excited to be here again today, this afternoon. So here's an agenda we're going to go through. So we're going to talk about financial reporting and projections, valuing your business, the M&A, which is merger and acquisition, the merger and acquisition step-by-step process, the different financing options that exist when you're looking to buy or sell a business. And then we'll open up for Q&A, but like Tony mentioned, you can put your questions in as we go, and Rob here in the background can take care of all of that while I'm presenting. The focus of this presentation, when you talk about succession planning, there's different layers of succession planning. The focus of this presentation relating to succession planning is more getting the most out of your business to potentially merge or sell the business. And then we will have some other succession items to talk about, very high level, but just so everyone knows, that is the focus of today's presentation, is preparing your business to sell. So the first section, financial reporting and projections. So with that, we do have our first poll. So Tony will go ahead and throw this question up there. So what time increments do you review your financial statements? Do you review them monthly, quarterly, semi-annually, annually, or I really don't get a chance to review them at all?
All right. Well, John, while those things are coming in, one of the areas of financial statements, when you're talking about them, are you just talking about P&L, or are you talking P&L and balance sheet or anything else?
Well, generally it's P&L and balance sheet, but that can also go into cash flow and budget comparisons. I mean, there's so many layers of reviewing financial reports, but this question more is, yes, are you reviewing your P&L and balance sheet? We can limit it to that. Okay,
very good. Well, let me end the poll and let me share the results. You can see overwhelming.
This is a good result. So, a lot of business owners that we meet with, until we're on board, generally, aren't really reviewing their financial statements at all. And some of them, it's hard to get them to even, put a financial statement together, go through that process and understand the value of a financial statement in general. So this is good news to know that 82% of the participants today are actually reviewing their monthly financial statements.
And John, one of the questions I would say is, there obviously is an investment in reviewing financial statements, both in time as well as money. Time that you are going to take to actually sit down and do it and get out of the monotony of the day, as well as the dollars you may provide to a professional, whether it be your bookkeeper, whether it be to our financial experts or someone. Obviously you're on the side of finances and you're like, of course you would want to do this. But have you seen over your years of experience sort of what I would say is the ROI of what are sort of been the big gotchas of not reviewing your financial statements? And maybe this is what you're getting into.
Yeah, some of it is. I mean, there's no specific calculation that if you do or don't review your financials. But basically what we say is, how do you know, if you equate this, say, to sports, how do you know if you're winning or losing if you're not keeping score? And we meet with a lot of clients that make decisions based on their bank account balance and not necessarily their financials, which up to a certain size that may work. But once you cross over and you start to own multiple centers and your businesses get larger and larger, that methodology will fail you. And because it doesn't account for any liabilities that may exist that are out there. So if you have $100,000 in the bank, well, you may have $150,000 in obligations to pay. So you're technically at -50, but in your mind, you're at +100. That's where the problems kick in with our clients. And, we have to educate them on the importance of this. And then really, how do you track it? What's the best methodology for tracking it? And when you're looking at succession planning and selling your business per se, any educated buyer is going to find these things. They're going to dig into your numbers and they're not going to just rely on your bank account balance. So you can lose significant dollars in value by not tracking your information properly along the way.
Good point.
So financial reporting. So it all starts here. So there's no way to value a business without information. So what information is valuable in valuing your business? So the minimum financial reports that you would need to manage your business are listed here. You need a budget, right? Where are we going? What is our plan? Your budget could have a lot to do with your value. There's reasons maybe why you haven't hit your budgeted numbers, but having a budget can show a potential buyer show them the potential of the business. Balance sheet is important. So what is a balance sheet? It's funny. I had a client, when I asked a new client for a copy of their balance sheet when we first met, and this is not a joke, they asked me if they could purchase it at Staples. Where do I get a balance sheet? They actually thought it was a certain sheet of paper that they could buy. So balance sheets are harder for non-accountants to understand. So typically business owners, and I'm glad Tony asked the question in the poll, they will look at their P&L, which we also call the income statement, more than they'll look at the balance sheet. However, the balance sheet shows the cumulative worth of a company. So what does that mean? The balance sheet is based on a specific day. So as of today, this is your balance sheet. The balance sheet doesn't cover a period of time. The balance sheet covers all periods of time from the beginning up until today. The income statement covers a period of time. You can look at your monthly income statement. You can look at your quarterly income statement. You can look at your annual income statement. So that's the difference. And the balance sheet can tell us the strength of the company historically. What is the company worth? It's almost like a house, right? Your house is worth $100,000 and you have a $50,000 mortgage. So then the net value of your house is really $50,000. Your balance sheet will tell you the same thing about your business. What is the business worth from a book value perspective? So it's very important to understand and have your arms around your balance sheet. Statement of cash flows. That's important, right? Cash is king. You've ever heard that term? Essentially, it shows us where all the money went. What came in, what went out, where did it go? Where did it come from when it came in? Was it all sales? Did we borrow money? Did the owner put in money? Where did all the money go? Did we pay down loans? Did we pay for expenses? Did we pay payroll? So a statement of cash flows is going to help us follow the cash, which helps us operate the business. And then you look at kind of the key numbers within your financial statements. And we just broke out two here, the two most obvious and common that would pertain to any business. You want to have a handle on your revenue. Is it going up? Is it going down? Why is it going in one direction or the other? And then payroll is generally one of the largest, if not the largest expense on anyone's income statement. So we want to make sure that if we have no other data, that we have our arms around the significant revenue items and the significant cost items, which we would typically say is payroll.
Hey,
So,
John,
yes.
let me jump in, usual here, and you maybe talk about this later, so please push me off if we are. One of the things in our ECE world, our childcare business world, unlike manufacturing or product businesses or the like, we don't have a lot of hard assets, but we have a lot of goodwill. Okay. And if you don't mind, I know you might be talking about this later, but the value of assets as to the value of goodwill when it comes to like your balance sheet, is that something that you can actually capture within the balance sheet?
Right. Great question. So no, you don't capture that on the balance sheet. So your balance sheet is what we call based on actual numbers. So dollars that you've spent, money that's come in and gone out. The goodwill of your company are the intangible items. So for example, it's the years in business, it's your name, it's your reputation, it's your client list, it's your employees. So that is, calculating that is what we will get into a little bit in this presentation, but that isn't on the face of your balance sheet. So if your balance sheet says that your equity is, in my example, $50,000, that's what we call your book equity. Your market value equity would most likely be much higher than that because that will factor in all those intangible items that I mentioned.
Great, thank you.
So when we put this all together, you can't put together a set of financial projections without this information, right? So that's the important part of why financial reporting is important. So with that, we'll go with our next poll question.
All right, one moment here. Poll question 2 and launch.
Okay, do you have a 2022 budget in place as of today? So single choice, yes, you do, no, you don't, or you're working on it.
All right. So one of these things is one of the clear issues too, John, when you talk about putting in budgets, especially for a future year, when you're talking with your clients and our members for that matter, do you have a specific time of year if they're on a calendar year fiscally, or is there any time that doesn't really matter during a year when you work on budgets?
So generally the end of the year. So right now we are, as accountants, we are in what we call budget season and tax planning season. So that's typically the main things that happen at year end. But certainly you want your budget complete before the year ends, so that you know kind of what your targets are for next year.
Yep.
So we're kind of split here across the board. We have some that already have theirs done, some that don't, and others and haven't started working on it, and others that are working on it. So this isn't a surprise. We have clients that have never done a budget, as much as we, kind of, promote it. But that's not a surprise to see that's kind of across the board with our group.
And a question for you, John, there's a lot of people, like I even know with myself, there have been years that I've been very focused on a budget and getting one done and really spending a lot of time. In other years, I've been just so caught up, all transparency, completely caught up and not being able to spend the time on the budget that I wish I had. I guess when it comes down to it, obviously having a budget, again, really helps you create a game plan. We're using our sports analogies here for the following year. Is there something else with the budget that does for you, I would say things that you wouldn't recognize really up front, how it could help you out throughout the year that, outside of having sort of a playbook for the coming year?
Yeah, I mean, it hopefully will help you avoid surprises, number one. So if you have a plan going in, and the easiest way to start a budget is to, and if a lot of you use QuickBooks, it's really easy. I would just export your rolling 12 months, the last 12 months from your P&L into Excel, into a spreadsheet, and use that as your basis for the following year's budget. Then I would go into these sub-budget categories like payroll, the items that you can predict easier. Your rent's easy to predict. Your utilities should be close to being able to predict. Payroll, your current staff and an estimate of hours. So you really have to break it down into smaller pieces, but it will help you avoid surprises later.
And before John continues, just for our audience out there, something that doesn't deal with succession, we have to always look at in our industry price increases. And this past year, with the rate of inflation that we're seeing, understanding what your 2022 budgetary constraints are going to be, or what your spend looks like against what your projected revenue is going to be, is significant. For us, for instance, we've decided to do an out of cycle increase in enrollment costs starting in January across the board because of such rapid inflation, but that's because of budgeting. So back to you, John. I just want to let you know that's also another place where budgeting has, really helps us in this industry and, scoping out what we want to put for tuition.
Yep. Okay, so on the topic of financial projections, so businesses are valued on prior and future cash flow. So this is important to know that when we're valuing your business, it's not just what's already happened, it's what is expected to happen in the future. So that's why a budget is important to have, and a projection is, and when we use the term projection and budget, they're interchangeable, just so everybody knows. So how do you prepare a budget? Start with the current budget financials and a list of assumptions. And these are the different metrics you can consider, like Tony mentioned, revenue growth rates, pricing should be considered, reviewing your KPIs and saying, hey, that certain KPI we didn't hit last year. We plan to hit it this year. So what do our numbers need to be in order to hit that KPI? KPI meaning key performance indicator. We actually did an entire webinar on KPIs earlier this year. What's the labor needed if you do expect to grow? How much labor might you have to add? How about raises and bonuses? Is minimum wage changing? Hours, are those going to change? So we're really big on narrowing down the big items, and then typically the smaller items like supplies and utilities and things like that, you can use some percentage increase, based on inflation, and not spend a lot of time on those areas. You're going to capture 80% of your budget in the bigger ticket items and focus your time on that. Any costs, and you have any large expenditures, fixed assets, fixed costs, projects going on, expansions going on, equipment that you need. Want to review all that and put that into your budget. That affects more of your cash flow. Are you going to finance any of that? That should go into your budget if there's any financing. And we have capital expenditures on the list here. And then, like I said, your variable costs should be easier. The cost side, expense side is much more controllable than the revenue side. You're not sure how many families are going to sign up all the time. That you're going to have to do some kind of growth projection that you're shooting for. But these are the pieces in order to get a good set of financial projections put together. Other pieces, set defined goals based on your history. So we have industry data, which we shared on some of these webinars, and then we have your own history. So it's easier to prepare a projection based upon yourself. Now, the industry is a guide, and that will let you know if you're in line or not with industry averages. But the best place to start is comparing yourself to yourself, especially if you've been in business for several years. Map out the revenue and expense at that point by month. It's much easier to do this monthly because certain expenses, there's times a year when you're busier than others and your expenses kind of move. It's not like you have a flat revenue and flat expenses all throughout. I've seen those budgets before where, hey, our labor is $200,000 a year, or $240,000 a year. So we have $20,000 a month across the board. Then we hit the first 3 months and our payroll is way over 60,000 and it doesn't meet our budget. It's because that was a sloppy budget we prepared. We didn't spend the time on the budget. Anything after the budget is just history, right? When you review a monthly financial statement, you're reviewing something that can't change. It already happened. So that's the exciting and valuable part of budgeting, is that we're projecting the future and seeing if we can meet those numbers. When the month is already over, there's nothing we can do to change things. So this helps you, and you don't want to wait 6 or 8 or 10 months before you look at any of this, because that's missed opportunity. You could have been running high on payroll for 6 months, but if you're not looking at your financial statements monthly or looking at your budgets, you would have never known that. And we've seen that mistake happen a lot. We meet with business owners that hadn't been exposed to us before and review some historical data, and they're like, gosh, I've been wasting money for years and didn't even realize it. So you don't want to be in that situation. But here are the detailed sub budgets that I mentioned before that can really aid in preparing your overall financial projection.
And when you've been in the childcare industry for a while, you start realizing that our industry has, a cyclical element about it. We know that things will sometimes slow down a little bit with enrollments before the end of the year, pick up at the beginning of the year. Then when it gets to moving over to summers and school age programs, for some schools, it really, blossoms. For others, it really contracts. And then most of us in the fall have a big shift over when kids are going back to school and childcare starts to get up and ramped up again seriously. So there are definitely cyclical times for us that really affect the big numbers like John was talking, like payroll, for instance. And being able to project there is huge because of things when you get into shortages and look into what do I need to do to sort of take advantage of those revenue opportunity numbers. So thanks, John.
Absolutely. So now that we have this data, we have our financials, we have our KPIs, we have our projections. How do we take all that information and value the business, right? What is it actually telling us from that perspective? So with that, we'll go with our next question.
Absolutely. And bringing up question number 3, launching.
Have you had evaluation performed on your business? So one choice here, yes, and it was recent. Yes, it was a while ago, or no.
And John, there's different levels of valuations out there from because of different kind of requirements. Like, for instance, the SBA may require a valuation for loans and things of that nature, as well as one maybe for a succession. What are your thoughts around the different types of valuations out there?
Yeah, there's many. My first caution would be don't overspend on one. And we have a valuation specialist here. Sometimes you may not need a valuation, you may just need a calculation. So if you're just wondering what your business is worth, your CPA should be able to do a calculation and give you a range of what your business is worth. But there are different purposes. Divorce is one reason to have a valuation. Succession is one reason to have a valuation. Gifting is a reason to have a valuation. Like Tony mentioned, financing. Now the SBA requires when you do an SBA loan that you need a valuation so that they know their loan is protected by a business that has a certain value. So there are different levels of valuation. So if we look at the results here, we've had a couple recent valuations. We've had some a while ago, but most have not had a valuation. That's what I was expecting. In a lot of cases, there's not a reason to have a valuation. Like I said, I'd much prefer a calculation. Even if you're going to sell your business, doesn't mean you need a formal valuation done. Formal evaluations can cost you up towards $10,000 to be done. And you have to make sure that you're getting enough benefit out of that cost.
Well, and John, let me ask you, you can have a valuation done. What role does it play in sale of your business? In other words, because you had a valuation, does it define the value of what your business is going to be sold for?
Not really. I mean, whenever anything's sold, and just going back to the analogy of selling a house or a home, you can list your house for $1 million. Doesn't mean it's worth $1 million. So right. The true definition is a business is worth what someone's willing to pay for it. I'm sure we've all heard that comment before. And the same thing here. We see it all the time. We were just dealing with a client that owned a liquor store and the seller wanted way over value for it. And we had to prove, and our client isn't financially savvy, and we had to prove to them through these financial metrics we're talking about today, that the business wasn't worth that much. And as adamant as the seller was about the value, because he was passionate about I haven't met a business owner yet that hasn't thought his business is worth more than what it's really worth. There's very few that don't feel that way. So there's a lot of negotiating involved here in this process. And yes, just because you have a valuation doesn't mean it's worth that whatsoever.
Yeah, and one of the things I would say is, John, oftentimes I know that you're representing on the sell side or the buy side, when someone is selling the business, a buyer will oftentimes require a valuation or something of that nature, which gets the seller spending money towards this. What are your thoughts when you're representing the seller and a buyer's requiring a valuation? Where do you tend to end up on that?
I would encourage a calculation, like I mentioned before. I would encourage the CPAs of both sides to get together and share their independent calculations. We just had that situation too, where we prepare and let each side poke holes into it as to what's unreasonable. The things we're going to look at to come up with that calculation are the things we've already talked about on this webinar. So let's get the financial teams together and share information and try to get closer to the value. Sometimes people list their business based on what they need to retire. And that has nothing to do with what the value of their business is. So being prepared, window dressing, just like you stage a house for sale, you want to stage a business for sale. Is your information in order? Is it accurate? Is it readily available? All those things matter when you go to sell your business. It's not like you wake up one morning and say, you know what, I'm tired of running this business, I'm just going to put it on the market. No, there's a lot of preparation involved, unfortunately, to get out of your business what it's really worth.
Yeah, very good. Thank you.
So talking about valuing your business. So how do we do this? So businesses are typically sold based on what we call a multiple of Ebitda. So this is this strange term that, financial people throw around, and it makes us all sound probably smarter than we are. So I'm just going to break this down into what is Ebitda if you don't know the definition. So it's your earnings. So that's the business profit before your expenses of interest, taxes, depreciation, and amortization. So those items of interest, taxes, depreciation, and amortization don't affect the operations of your business. Some companies borrow money, other companies don't. So we take that factor out of it. Depreciation is a non-cash expense, right? So if you buy a piece of equipment and you paid for it in 2017, but you still may be writing that off through now, that expense it wasn't like you spent the money each year for that depreciation. So we try to get to what we call an adjusted earnings number, which is what this Ebitda number really is. So then you take that Ebitda number, so that we have an example in here to show you, and we adjust it, because we all know there are items in everyone's income statement that aren't necessary for the business to function. There are spouses being paid, there are kids being paid, there's travel that's on the company's books that really may not belong on the company's books. There's the owner's auto, there's the owner's cell phone that may not always be used for business. So those are what we call discretionary add backs. So we would add back all those discretionary items and get to a larger number. So the goal here, if you're selling, is to make this adjusted Ebitda number as large as possible. And you have groups, specifically private equity groups, that say, hey, we're only looking at companies that have Ebitda of 2 million or higher, or 1 million or higher. So you don't even get into those buckets of strategic buyers without a certain Ebitda number. So your Ebitda is super important. And when you're looking at your monthly reports, you should also be looking at your Ebitda number. The other piece here, and we did talk about this in previous webinars, is how real estate impacts your value. So real estate is valued completely different than your operating company. Real estate is valued on cap rates and the strength of leases and the market and comparable sales. There's other factors that come into the value when you have real estate. So this is kind of the formula to start to value your business, the Ebitda calculation.
And John, some questions for you. So owner discretionary, I think with many small business owners, I would raise my hand, I do run a number of things through my business as owner discretionaries. There are some different theories about owner discretionaries that if you are going to sell, you have to try to extract and get rid of all those owner discretionaries several years before you want to sell. And then there's others who say, well, that's just sort of expected that there are going to be, but as long as you have tracking on those that are pretty solid, you don't really have to extract those. What philosophy do you sort of have when it really comes to owner discretionary and the businesses itself when it comes to the different types of buyers out there?
Yeah, I think what we like to do is segregate the owner discretionary, what we call below the line. So when you're keeping your financial statements, your operating business, all the expenses that you see that are ordinary and necessary to run your business should be what we call above the line. Any owner discretionary and these items here, interest, taxes, depreciation, amortization, we generally like our clients to keep those below the line so that we can track the operating portion of our business from the discretionary portion of our business.
Okay, when you say below the line though, can you further describe that for those who may not be familiar with the term?
Yep. So basically, above the line would be your sales, your operating expenses, and then we get to a number that we call your net ordinary income. So that's more or less your profit before any of these other items. So you want to manage your business on that net ordinary income number. Anything below the net ordinary income, we would consider discretionary. So maybe your net ordinary income is 100,000 a year, but your net income after you take the discretionary items out is only 50,000. We don't want you to manage your business as if it's a $50,000 profitable business. It's really a $100,000 profitable business, but we have these other items in there. Typically, taxes are the reason why we have these other items in our books, right? Haven't met a client yet that likes to pay taxes. It's a good thing though, if you do owe taxes, that means you made money. So that's the accountant's counter to someone being depressed from owing taxes.
I don't know, Gamble might like, no, I'm just kidding.
Yeah. Yeah, some accountants
joke.
try to find ways for you to pay more taxes. I'm not sure why. But yeah, our job is for you to pay less taxes. But that's why taxes are added back here, because that's not a factor in the value of your business. What you pay in taxes is not a factor in the value of your business.
And we talked about the impact of real estate. You know, there are multiple philosophies out there from the different types of buyers. If you're selling, there's, you know, obviously like venture or your equity or your money buyers. There's your roll-up buyers who have a number of schools already. And then there's sort of peer buyers, as I would say, who are just looking to constantly expand. And then there's really new buyers, people coming into the market. Do you think that it matters the type of buyer, your position on whether you have real estate or not? I know that's a pretty vague question, but.
Yeah, first of all, the type of buyer matters. The type of buyer matters significantly. And we break them into two buckets. There's your kind of individual buyers and there's your strategic buyers. So you'd much rather sell to a strategic than an individual. So if you were just listing your business for sale and an individual person was interested in buying your business, they don't have systems in place and resources in place already from their other business or other investments they've made. So they're going to need every resource you have within your business. They're not going to save any money buying your business. A strategic buyer may have a lot of pieces in place. You know, they may have an administrative staff that handles all that remotely, and you could remove that from your expenses. They may have operators. They may have different supply contracts where they're not paying as much for things. So they can scale better. So you much rather position yourself for a strategic buyer. However, strategic buyers look for a certain size. So, you know, if you're a certain size, then your budget should show you wanting to get to a bigger size to attract strategic buyers. Strategy with the real estate is some strategics don't want the real estate. They just want the operating company. So that's good for you. So then you can either piece that off, sell the real estate separate, or even better, if you're going to sell your business and kind of retire, keep the real estate. And now you're the landlord and you have a qualified tenant running the business. And that's another piece of income that you can keep, you know, for as long as you want. And then maybe you sell the real estate down the road, you know, because that is valued differently. So there's a lot of strategy behind how you position yourself here.
Great.
So here's the example that I mentioned before. So we took this estimate of a business, and we mapped out the historical information going back to 2017. So we have 4 years of data here that we summarized for this business. So if you look in 2017, and we're focusing on that Ebitda number, the Ebitda number in 2017 was 22,450. And then it's grown over the years all the way to 75,775 in 2020. So this is a key number in valuing your business. Then we looked at these, what we call discretionary items to increase your Ebitda to a higher number. So if you look at this company actually had a PPP loan that was forgiven and converted to income. Well, that's not what we call real income. So when someone's looking at your numbers, we're going to take that out of your numbers. So that's one of the reasons why 2020 looks so good from an Ebitda perspective, but from an adjusted Ebitda perspective, doesn't look as good. And then we had auto expense that we're assuming is personal by the owner. And we have the owner compensation, which we always add back the owner compensation because you're not sure how the buyer intends to manage the business. Leave it up to the buyer to add expenses in if they don't believe these numbers are how it would look for them. So we take these 4 years and we apply a weight to each of the years. So what we did here was we said, okay, if we have 100% here, we're going to assume that 2017, 18, and 19 would all be equally weighted as far as Ebitda, and 2020 would be weighted less. Now, the reason 2020 is weighted less is because of COVID. That was a year, as an unusual year. We consider 17, 18, and 19 more the norm. In 2020 and now probably 2021 and hopefully not so much 2022, more abnormal. So we use this weighting system to come up with a weighted average Ebitda. So in this case, the weighted average was right around $76,000. And then we use a multiple of Ebitda. So how many times Ebitda is a business worth? In your industry, it's a range. The range we're using is 3.5 times to 6.5 times. Now, a lot of this depends on, are you selling it to a strategic? Do you own multiple centers? Does the business rely on the owner for everything? There's a lot of factors that will determine your multiple, plus the market. What are businesses trading for? But in this example, if you take all these multiples and round them and then average them, we're valuing this business at $383,000. Okay, now that's debatable. Someone could come in and say it's worth on the low end $268, on the high end $498. So this is where the negotiations kick in. But back to the question about, paying for a valuation, I would pay for this analysis first. It gives you a lot of good information about the value of your business without spending $10,000 on a formal valuation that might have more of a rubber stamp on it, but it still doesn't mean someone's going to pay that. So this is something that we could help you put together for your business. And we recommend that you update this at least once a year so you have an idea of what your value is. And then one of your goals should be, well, I'm ready to sell my business when it's worth 500,000, 600,000, $1 million, 2 million, whatever your number is, whatever you're working out with your financial advisor from a retirement perspective. This is, why are you running a business? What is the reason? Are you running a job or are you running a business? And then if you're running a business, what are your goals? What are you working towards? What value are you looking to get out of this business that you put everything into over time? So this is a nice report card to help you, understand where you're at. If this number is significantly low and you don't see the opportunity to make it larger, then maybe you're in the wrong business or you need to change something. You just need to cut your losses and sell it and move on to something else. And that just all the hard work doesn't seem worth it to you. There's a lot of things that this can tell you, but you need the information first in order to do all the analysis. So this kind of just touches on the industry multiples. So like we mentioned, we have several clients in your industry. We've been involved with a bunch of transactions in your industry, and these are the multiples that we see that businesses in your industries are trading at. Multiples of Ebitda are 4 to 6 times and sometimes higher depending on the market. The multiple of SDE. So SDE is seller discretionary income. So this is how much money does the business produce that's available for who may buy the business, and how much is available for who's selling the business. What, if we add back all the different costs that are in here that aren't necessary and the other items that we talked about, what is the kind of the worth here to the business owner? And then as a percentage of sales, we're seeing businesses trade between 55 and 60% of sales. So if you're a $1 million business, you're selling for somewhere around 600,000, somewhere in that range, maybe a little bit lower, but that's not the only factor. Some businesses run much more efficiently than others. $1 million business may be producing $300,000 a year in profit. Another one may be only producing $100,000 a year in profit. Those businesses will be valued much different, even though their sales are the same. This is just a guide based on the industry.
And John, this is for the childcare industry, just not the industry in general, correct?
Correct. This is just childcare.
Okay. Fantastic.
Yep.
And folks, keep your Q&A questions coming. I know Rob is working diligently on getting those answered while we're talking here too, because we may run a little short on time.
Yeah, we'll keep moving here. So, these are key value indicators. So I touched on this a little bit. Characteristic of value center. So if your revenues are $1 million or higher, then you're in a different bucket than the smaller centers as far as value. Your multiple will be higher in the $1 million and higher bucket than it would be in the smaller centers. Licensing capacity, if you're over 200, your value will come out higher as a percentage. If your enrollment's over 200, so there's some key indicators here that can help drive your value. And they'll draw higher multiples. And then you also get looks from national providers versus individuals. You'd much rather go with those strategics if you're selling. Smaller centers, you still can be profitable. Strong operators will draw significant value, but you're going to see more of the Main Street buyers than the national buyers in that. And maybe the cash flow is just so good in those smaller centers that it might not make sense to sell. But that's an analysis you'd have to do.
One of the things I want to add in here for everybody out there too, if you're not looking at succession in the very short future, and John, if you don't mind backing up to that slide you just had, one of the key elements is how do you build your business for succession? And if you look at what John positioned here, this is all about possible strategy of growth too. So today you may have 1 or 2 schools, maybe you have 6 schools, but what you want to do is you want to sort of parlay those schools up into a very, appetizing endeavor for, an organization, a national provider or a money organization. So these kind of stats, staying close with the financial experts here and trying to understand what is it that they're looking for allows you to look at what you might actually want to go through an acquisition on now, or at least scope yourself to grow to, so you can position yourself for, a succession, down the road. And these are the kind of key things to understand as who is buying what.
Absolutely. So we'll take you through the M&A, the merger acquisition step-by-step process. So once you've figured all this out and you want to go to market, this is kind of how it works. So poll question, have you ever bought or sold a childcare business?
All right, as we wrap up the question here, I think this is our last one, is it not? Yeah.
Yes.
All right. So
bought or sold. Go ahead, Tony. You do this one.
I'll take this one on. Yeah. Have you bought one, or have you ever sold one? Have you bought and sold? Or have you even done this with other type of businesses outside of this industry? Personally, for myself, I came into the industry from buying. I bought initially 5, and then I bought a 6th one. But I have since also sold a business, and I also sold it separate from real estate. So there are multiple approaches, but it gives you a different perspective. And just because you were able to buy businesses doesn't mean you're in the best position to sell, which I've also learned, sometimes the hard way. So, John, I'm going to end the poll now and launch the results for you.
All right, so we have almost half have bought a childcare business. Only one has sold one. No one has done both. And one has bought or sold other types of business. And then we have 40% haven't bought or sold. So you must have started the ones you have from scratch. So it's a mixed bag here of results. So let's go through this process of how this merger acquisition works. So step 1, you want to prepare an executive summary and a reporting package. So this is kind of the window dressing of your business. Tell us some high level information. We call this a teaser, more or less. You want to pique the interest of a pool of buyers to want to learn more about your business. Second step, then you start to identify the qualified buyers, or if you're selling, or sellers, if you want to sell. So come up with that list. It's generally a competitor or someone on the national scene, but you want to come up with a good qualified list of potential buyers. Once you have those items prepared and you've shared some of that information, you always want to execute a non-disclosure agreement so that no one comes in and either steals your ideas, is able to compete with you, or more importantly, solicit your employees, right? So this is very important. There's not a lot of trust in these negotiations. So you don't want to share a lot of information without having a non-disclosure agreement in place. So you do have some recourse should a deal not work and something happens afterwards. Step 4, now you're going to start, once you have a non-disclosure, you're going to exchange some high-level data, financial statements, tax returns, reports on enrollment. You'll probably provide a tour of the facility, generally when no one else is there for privacy. You certainly don't want to disclose to anyone in your organization you're doing any of this until you know you have a purchase agreement. Step 5 would be a term sheet. So this is just a high level of the price and how it will be paid for and the timing. So you want to, before you get into any legal documents and spending money on that, because that gets pretty expensive per hour, you want to have a term sheet that both buyer and seller are in agreement with the general terms of the deal. Step 6, you execute, now you would bring an attorney in, you execute a letter of intent, which we call an LOI. So that letter of intent takes the term sheet to the next level. It's generally still not binding, but it does give you exclusive rights to negotiate with each other without another buyer coming in, right? So that's the protection you want if you're on the buy side, that, hey, I've gotten to the point where I have exclusivity for a certain period of time to finalize this transaction without any other potential buyer coming in and getting in the way. So at that point, you have this due diligence period. So now we're not just going to trust the financials we received or the tax returns we received if we're on the buy side. We're going to want to dig into specific transactions and learn everything we can about that business, because once you sign the purchase agreement, you really don't have recourse to go back and say, oh gosh, I just learned a bunch of things that I didn't find out during due diligence, and now I'm not satisfied with my purchase here. How are you going to finance the deal? So you got to get the banks involved, and if you need a bank, and obtain the proper financing during this due diligence period before you close. Next step is you execute the purchase agreement. So now that makes the purchase, quote unquote, final. And then you close the deal, where you pay for the business and you start the transition period once the business now has a new owner. So we work off of these 10 steps. We don't recommend that you skip any of these. But this is, the step-by-step process of buying or selling a business.
John, some key questions here. People have probably heard about asset purchase agreements and share purchase agreements. Could you describe for our audience here the differences, the advantages or disadvantages, and the willingness for people to take on one as to the other?
Yep. So asset purchase is basically you're buying certain assets of a business. The largest asset you're buying are those intangible goodwill items we mentioned before: the name, the location, the reputation, the client list, the staff. So most deals are done on an asset purchase basis where you're buying those, you're buying supplies, equipment, some things like that. But most of what you're buying are intangible assets. And then you're setting up your own entity and putting those assets into your entity. A stock purchase is when you're actually buying the stock of the existing company, and what we call more or less you're taking over the steering wheel. So the company doesn't change, the federal ID number doesn't change. You own that business that always existed. You're just taking it over. Now, attorneys don't generally like stock deals because when you buy the stock of a company, you're inheriting any sin that company may have had, any past liability. A creditor comes out from 10 years ago, you're still liable for any balance there when you buy the stock. There are tax implications as well from doing a stock versus an asset deal. We could do a whole webinar on stock versus asset deal. As a buyer, you would prefer generally an asset deal because you can write off those assets quicker and get a tax deduction. In a stock deal, again, you take over the steering wheel of the existing company and you pick up writing off the assets where the seller left off. Generally, most companies write off their assets right away, pretty quick. If you are selling a company, you most likely would prefer a stock deal because that transaction would be all taxed at the lower capital gains rates, where an asset deal necessarily wouldn't. So there's a lot of things to consider in how you structure a deal. And that's where we come in to help with our clients on this, going through the step-by-step process and then structuring the deal.
And actually, there are times, even though, as like John mentioned, that a buyer may only want to buy for assets because of their ability to depreciate. Yet in some situations, there are cumbersome things because of licensing or because of things that encumber the business that still make it a great opportunity to be bought. But because of whether it be licensing or rules with the town or taxes, if you can get to a share purchase agreement, that can sometimes get you through there because you are not having to basically stand up a brand new business, in the same area. So
Correct.
That is the kind of thing that you do want to, that's where a financial expert definitely comes in play.
Yeah, contracts transferring. So it's, there's a lot of things to think about there. So business acquisitions of timing. So year end, right? We're getting close to year end. Does it make sense to close before year end or after year end? So there's a lot of things to consider here. If you're selling your business, you're going to get taxed on it in the year that you sell it. So if you're anticipating tax rates to go down, you want to wait, in this case, till January. If you're a buyer, you want to buy now to get a deduction in before the year ends. There's a little tug of war there on timing. And it's just like any negotiation. You might give a little bit here to gain more somewhere else, but timing is important. How you allocate the purchase price is a little bit of what Tony was asking about. You want more, if you're buying, you want more of the price to go towards equipment and things that you can write off quicker, especially if you have income in that year and want to write off and need a write-off. Buyer generally looks for more of the 5 to 7 year useful life assets, which is generally equipment, furniture, things like that. So you can write it off quicker. All the intangible items like the name, the reputation, things we mentioned before, those are always amortized over 15 years. So whatever you assign. So if you're buying a business for $1 million, you need to put them into each of these buckets for depreciation and write-off purposes. So that's something to consider when you're buying and selling, because the allocation is the same for both buyer and seller. The IRS actually makes you send a special form and they match it up that buyer and seller are allocating the purchase price the same.
Hey, John, before we conclude here, we have to conclude soon. One of our attendees asked, how would you recommend finding buyers? Are there websites or lists and, to list your sale on? So in other words, there's people like the financial experts like yourselves who do this work. There's business brokers who do this. There's websites, there's Biz Buy Sell, there's, all these things. What is your take on sort of getting exposure for a business to be sold once you stand it up and do these kind of basics that you've been talking about?
Yeah, generally, so there's soft ways to do it and there's harder ways to do it, right? So the soft ways are quietly, because confidentiality is a big factor here. A lot of our clients don't want to hire a broker and broadcast that they're for sale, because the risk is you're going to lose clients, you're going to lose people, right? And now what is your business worth without clients and people? So the soft way to do it is to generate a list of local companies and national buyers. This is all over the internet. You can find it. We've done these for clients. And you send a letter with some high level information without disclosing who you are, that you would entertain the sale of your business. And then you solicit, then you'll get responses. And we've done this for clients where we've actually sent the letter and responses would come in, and we start to work with groups and qualify them to see if they could potentially be a good fit or not. That's one way to do it. Another way to do it is to hire a broker. There's broker, but you want to interview certain brokers, and you want brokers that understand your space, your industry. So you got to find the right broker. Now they will do an analysis and help you with the value and charge you a fee. And they will actually do the search for buyers and confidentially handle that on your behalf, so you can still run your day-to-day business. But the one thing you don't want to do is check out of your business as if it's already sold, because every day you check out, your value is declining. So those are the two most common ways to sell a business. But there's so much information out there today, especially some of these publicly traded companies. Everything is public information where you can find out who's really out there actively buying. And I prefer, with your accountant, going the direct approach versus always engaging a broker and paying a 10% fee or whatever it might be to do an independent search like that.
Yeah. And they do both have their purpose and their value depending on what you're trying to achieve. I think today's purpose we really have been spending time on, and I'm not meaning to cut this short, but I know we're short on time, is that really preparing yourself for a succession, getting yourself into place to know what the value of your organization is and really look at it. I think we will probably look in the new year of doing a webinar specifically on, once you have prepared yourself, then how do you position yourself for the best opportunity to sell your business?
Absolutely. So we'll finish up with the financing options. So there's different ways to, either finance your sale or receive the funds, finance your purchase or receive the funds if you're selling. Bank financing is probably the most common, but even when you do bank financing, you still have to put in some of your own capital. Generally, 20% is what a bank would expect that you put in, and then they would look at financing the rest. Ways to get a deal done when you don't have those two pieces in place is to have the seller hold a note for a certain period of time. That helps the seller from a tax perspective. It will spread the gain out over multiple years and spread their tax out. So some sellers like that. Other sellers don't like it. They want to know that they have their money and it's secure, and they don't want to wait for it. And they don't want to rely on you to run the business in the ground and maybe not pay them. There's earnouts that can be done. That earnouts are generally used when you think the business is worth $1 million and the buyer or seller thinks it's worth $800,000. You can say, hey, let's do a $200,000 earnout. If we hit sales of a certain level for so many years, then we'll pay you that extra 200. but we need to prove that out first before we give it to you. You know, so that's a way to get a deal done. And then you can also raise capital if you need it in order to finance a business. So there's a lot of pieces here to put the financing in place. These are just some examples and in the primary examples of how you can get a deal done. We do have some additional considerations that I mentioned. We focused on the sale of a business as your succession plan, but there are other succession items that we've listed here that we won't get into detail on. You can merge with another business. You can set up an ESOP where the employees own the business. You can transfer the business to family partnerships or trusts. And then we never want you to rely on your business as your retirement plan. So diversification is important. So making sure you're funding retirement and investing in real estate and life insurance and other things outside of your childcare business is very important. I've met too many clients that relied on their business as their retirement, got into some trouble and ended up with very little, and they're working probably for the rest of their life. So you gotta have other plans here besides just, hey, my business is my retirement plan.
One of the things as we conclude here that I'd like to get across to everybody too, one of the huge reasons to work with a financial professional on these things is, and I'm not going to underscore it, is the tax consequences of selling. That when you do sell your business, you may be, astounded even for what you're obtaining for your business. But then when you look at what the tax implications are, if you don't have it structured properly, or you've looked at, the fact that you're selling a lot of real estate with it, or you are, you're selling a lot of your different assets, and you realize that a lot of that, possibly upwards of 40% in some situations, it's going to go back in taxes. You realize, what is it that you've worked for over the past 10, 20, 30 years? It is really of critical importance to have a tax strategy all along with the sales strategy, and, the thing I wanted to end up here with, and John, I don't know if you want to say anything about that before I have one last, statement here.
No, I agree. I mean, there's just a lot here, right? So you really need a strategy and advisement. But the whole point of this is too many business owners, including probably Tony and probably me more than Tony, are stuck in their business, right? We're stuck in our business and we don't focus on our business, we're too tied into the clients and the staff and all the other factors that make a business run. And, this kind of takes you out of that and gets you focusing on your business and all the hard work that you're doing and what you could get out of it someday. And most of us business owners don't focus on this enough.
Yeah. And so for the last item here is John leads our financial experts for IC360. If you're out there and you're like, you know what, this was actually interesting to me, I'd like to get to some of those numbers. I'd love to see that projection. We do have, as part of our initial engagement with our financial experts, it's a 1-hour conversation with them. There's no cost to you. But it is an initial conversation with our financial experts, with John and team and Rob and Dan. And they have done just a great job of really trying to listen to you and not trying to position you in any way for anything other than understanding what your requirements are, what your needs are, and where you want to go. So if you are interested, please reach out to us. You could use the email below. You could use my email. Reach out to us and we will get you connected with our financial experts and get that call set up so you guys can get some of that, benefit of whether you are or not a member with IC360. So from Tony D'Agostino, along with John Rizzo, I'd like to thank you all very much for the time you've spent today. We are over our time. We did have some great questions along the way too. Want to thank you again. If you do have any questions for John and team, don't hesitate to send them to us and we will get those answered for you. Thank you very much, everybody. We will talk to everybody very soon. Take care and have a great day.